Thanks for joining us today. We're here with Tayon Mitchell. He is a Pittsburgh, Pennsylvania-based financial strategist, and he is going to guide us through a lot of those, sounds redundant to say strategies, but also the things that you can actually practically do. And I'm sure we'll talk about why you want to do them, because if you don't have the why, you won't do it. And then take us through what we can do to make sure our finances not just thrive, but soar. His program is called Mortgage to Millions, and it teaches you how to take the money that you use to pay off debt and also use that to create not just freedom from debt, but wealth. So we're excited to have you here, Tayon. Thank you for coming.
I'm excited. Thank you for having me.
You're welcome. Can you start us first off, just learning about you, who you are, your background, like where you grew up and how on earth you became a financial strategist?
Oh, sure. So, as you mentioned, born and raised here in Pittsburgh, Pennsylvania. Growing up, I actually wanted to play ball, football here. And, I ended up playing in college, and then it kind of ceased after that. And I had no clue what I wanted to do, with my life. But I came across, a few different financial books that kind of led me down this journey. One of them being Rich Dad, Poor Dad. And it was just one of those things when I was in school and I read that book, I was wondering why this good information was in the library, but not taught in school, right? I was like kind of confused. And so I just kind of continued on this journey of like personal development and reading a lot of business books. And I didn't go to school for business, by the way. Went to school for psychology. I'm heavily involved in the church and in ministry and things like that. But I was attracted to business, and just through reading a lot of books and talking to my colleagues about it and associates, none of them ever knew what I was talking about. And I said, well, you know what? Maybe I need to dive into the career of being a financial advisor. And so I worked for a company here called Prudential, and it was a financial advisor doing that. And then also worked for a company here called Liberty Mutual and learned the insurance side of it. And in about 12 years ago, I decided to kind of just jump ship and kind of decided to start my own company here with Unguard Financial Group. And, we help families find the money that they're losing unknowingly and unnecessarily. And so we teach a lot of different strategies that a lot of advisors, I would say, aren't permitted to probably speak to their clients about. And so we just kind of uncover all the details that really help families build wealth and just show them all the secrets of the wealthy and what they're really doing to obtain that generational wealth.
I find it interesting that you started with psychology, because I think there's so much psychology behind what you're doing now, and I'm sure you use it all the time. Could you maybe explain to us or educate us a bit on the reasons that people need to take charge of their financial health, and also maybe some of the things that keep people from doing that? Let's say the top 2 or 3 things that you think inhibit people from doing that.
Well, in the beginning, I mean, it's not taught anywhere. Let's start there, and so I can at least speak here. The education that I got, most of it was self-taught. And so, a lot of that information is either taught in the home, or you have to end up finding a mentor or something like that. But in the school system, it kind of keeps you to stay employed and not necessarily have your money work for itself. And so I would say that's one of the big reasons that people are held back. And I would say another thing is it's discipline. We want the shiny object, and, we see what other people have, but we're not willing to learn what they know to achieve what they have. And we just want to kind of skip steps. At least a lot of times I see my clients still want to hurry up and buy the latest and the greatest thing. And I say, well, it would have been better if you had your money work for you to be able to purchase that than, you using your time and energy to go ahead and purchase that. And so we're kind of taught things to, you work, you buy, you work, you buy. And my whole thing is we work and we allow our money to work for us and allow our money to be able to pretty much finance the lifestyle that we're after. And so those are a lot of the principles that I teach here. Was there something else? I think I might have missed something else that you might have asked. I'm sorry.
I think that was it. I think you pretty much combined them together, both questions and the answers, and it made complete sense. I completely agree. I do not remember learning maybe a few things in one class about money management in school. And we could speculate as to the reasons that is the case, but you are entirely right. School is designed to create workers, not entrepreneurs, and not people who can figure out how to spend their time to get their money to work for them. That's something that's a foreign concept to many people. Let's dive into that a little bit more. How on earth can your money work for you instead of you just spending your time to make money?
So there's several formats. I would say the most popular way is through real estate. I would say people kind of do that here. Then you'll have the paper assets for people who have, they invest in stocks, bonds, and mutual funds. My way is a little bit more unique because I look at it as, you can get into real estate. However, most people, you got to kind of have a nice nest egg to get involved in the real estate. However, when you go to the stocks, bonds, and mutual funds, there's a lot of risk there. And there's something that I teach here, talk about a specific wealth account that we'll dive into maybe in a few more questions or so. But and what that looks like, where I show people how to position their money where it's always working for them in the background. They also always have access to it to make major capital purchases that they would make anyway, but their money continues to keep building and keep compounding as they make these major expenses that they have regardless. And so we could dive into that a little bit more if you're ready right now. I'm not quite sure yet. So,
well, first, I just would like to talk to you a little bit about what I mentioned before we started recording, that a lot of people find the language around money really intimidating. Even hearing the word like a capital and ROI and just these terms that for you are part of your everyday lingo, for other people, it's like hearing a doctor talk about a diagnosis and they have no idea what it refers to. And it all just refers to the way that money is formatted, I suppose. Could you, or do you have, as part of your program where you educate people about what these terms mean? Or do you, I've seen TikTok accounts that they'll go and they'll just literally have a lineup of words of the financial terms and then tell you what it means in layman's terms. How do you help people overcome that hurdle of knowing what on earth is being discussed?
Absolutely. So that's really good. So yes, we do break down certain terms, but I would say even more importantly, we actually bring terms to the market. And where I'm not going to say water it down, but we use everyday language that people can understand. And so instead of using these, 10-letter words, where I got to look at the dictionary, like, what does that mean again? We bring, just normal words to the marketplace where people are able to understand, kind of get excited. I like to use a lot of analogies. Anytime, we're helping our clients walk through their situation, I try to meet them right where they are, and try to use a story based upon something that's in their life. I'll say, so it's like, you being on a podcast and you're doing this, and that. And so they're like, oh yeah, you know what? I do this every day. That makes a lot of sense. And so that's the one thing I should say I work really hard to do, because it's meant to make it complicated and make you fearful. And you just put your money in a place and you just kind of hope and pray that you'll get the return one day. And it doesn't work that way. You have to really understand what you're doing in this industry if you want to be, obtain any type of wealth at all. You got to understand the language and you have to understand what you're doing. And so I just think it's unfortunate that many advisors speak in these large terms to sound smart. And a lot of clients, out of fear, they'll still put their money with them, assuming that it's going to go well, where we try to educate first, because we don't want to sell you on anything. We want you to buy because you understand and you're making a business decision to do business with us. And so we lead with the education first. And that's the most important thing, because if you don't understand it, I don't want your signature on anything. You know what I mean? You have to be able to understand it for us to even consider doing business with you.
One thing that I think people also don't understand is that, like what you've just mentioned, when you hire a business strategist or you're working with the business strategist, or sorry, financial strategist, and you're doing business with them, it's a service that they are doing for you, as in you're buying a money service, you're buying a financial service. You're not, I think a lot of people think that, and this is where I'm really glad you said what you did about teaching people and having them using analogies and educating them, because a lot of these financial advisors will say, oh, well, this percent of that goes to us as our fee is only an extra 0.5 per year. And then people think, oh, that's not a lot, but they don't understand the accrual over time. So I'm really glad that you're really honest with people, and teach them and educate them with that. I know a lot of, having read some books about these practices, sometimes it is very complicated. And I think it is designed to be that, so that the people who are already adept at the game can carry on benefiting from new players, I suppose, is the analogy I would use.
Right.
So with your program, can you talk to us a little bit about if someone is coming to you, and I think from the Mortgage to Millions, if we could start with maybe that typical story, because it sounds like it is a typical type of customer who would come to you. Someone who comes and says, I have a mortgage, I have $40,000 of other debt, and I have a mortgage. And how do I fix this? Where do you start with them?
Great. And so then I'll say, Jeannie, is that with the term mortgage to millions, a lot of people do assume that you need to actually own a house. And I will say, you don't have to at all with our mortgage to millions program. The whole idea of it was that we could help families become debt free within 5 to 10 years, including their mortgage if they have one. And if they continue with the program, by the time they reach, 30 years in, they'll have amassed up to $1 million, if not more, in their retirement plan, outside of what else they have in place through their employer. But with that person, obviously we do a full financial analysis, looking exactly where they are. And, so are they currently overpaying on their mortgage? We look at any other debts that they have, credit cards, student loans, car note, any tax debt, medical bills, anything like that. And so we itemize everything. And the first thing we look for is any discretionary income within a person overpaying their debt. And so a lot of people who come to us, they're currently already looking to get out of debt, and they've been following, you may have heard of Dave Ramsey or Susie Orman. They use something that's called like a debt snowball. And so they may already have that in place, or they're just using that discretionary income, and hey, I'll pay $100 more on this car note, $100 more on this credit card, and it's kind of sporadic. Whatever the situation is, we take that discretionary income and we create what's called a wealth account. All right. And here we use a mutual dividend paying cash value life insurance policy. Okay. And so that's what we use. And we hug it right next to their debt. All right. Now, I'm going to go into the formula and the details of it, but we use this discretionary income and we put it in the wealth portion, the cash value portion of the policy. And so there's ways to put the money directly in that area so that you have access to it. Okay. That money continues to compound. Okay. And then when you have enough money in this account to be able to pay off the lowest debt, we're going to borrow from the policy, pay off that debt. We're going to use that discretionary income and refund the policy back up. Now, what people may or may not know, when you use this strategy, you're not withdrawing from the policy, you're actually borrowing from the policy. And the reason why we want to borrow, Jeannie, versus being able to withdraw from it is the insurance company is going to lend you their money because you put your money inside the policy. Now, why do we want to do that? The reason why we want to do that is because your money is going to continue to compound as you use the insurance company's money. And so your place is being held in line. So we're holding your place in line, paying off the debt. As we pay off that debt, we recoup that discretionary income and we're putting it back. And now we're at a higher place in line. It's kind of like, imagine, Jeannie, you and I, we went to the grocery store and you're like, oh man, I forgot to get the eggs. Can you hold my place in line? And so you run and you get the eggs, but by the time you come back, I didn't start over. I'm actually closer to the cashier now. And we're doing the same thing with the wealth, is that you're going to be paying off this debt anyway. I wrote a book called Spend Differently. You're going to be purchasing a car anyway. You're going to go on vacation anyway. And so instead of me telling you what you can't do, I'm just going to show you what else you can do, all right? And hold your place in line. And by the time you're done, you're going to look 20, 30 years down the line, you're going to say, wow, this was actually one of the best financial strategies I've ever implemented. It wasn't any risk. I was able to hold my place in line. My money was compounding with interest. And the best part is I have access to it tax-free.
That's amazing, especially that it's tax-free. I love that.
Yeah.
I wanted to ask what you were talking about just now, and you borrow from the life insurance company's money, not your policy. With that, and you're paying that back, I'm assuming that's at a lower interest rate, or how does that work as compared to just paying off your debt with your own discretionary income?
Yeah, so think about it. When you just pay off your debt, you're not building wealth. So for starters, so that's all you're doing. So the wealth side, you're at zero, and you're just taking your discretionary income and paying off the debt. That is a way to do it. I believe that what we teach in Mortgage to Millions, we call it a wealth snowball, by the way. I believe that the wealth snowball is a lot more beneficial than a regular debt snowball. Now, whenever you do borrow from the insurance policy, there is an interest rate that you have to pay. But what I tell people is that even if the interest rate is the same, you'll still be in the positive. So let me give you an example. Let's say you have $100,000 inside of your insurance policy. And let's say you go ahead to, and let's say the interest rate's 5%, by the way. And let's say you borrow $40,000 from the policy, and that interest rate on the loan is 5%. Well, if the policy's growing by 5% on 100,000 and you borrow 40,000 at 5%, you see you have a spread there. And that's what we're after. This is what we call, you become your own banker, okay? Yeah. Because you're making that spread in between what the insurance company is giving you and what they're charging you on the loan. And on the loan itself, it's simple interest, Jeannie, but your money's growing by compound interest.
Ah, okay. That makes a big difference as well.
Big difference.
Yeah. I like the way you've explained that, is you've only taken part of it and your other money is accruing. And so, yeah, that makes a lot more sense.
And let me break that down just a little bit more for your audience. So using the same example, you have that $100,000 and it's earning 5%, okay? And let's just say this person's looking to purchase a new vehicle, and that vehicle costs $40,000. there's two ways that they could do it. They could go to the dealership and, they could finance it, or they could decide to purchase it outright. And so they're going to borrow from their policy. Now, when they borrow from their policy, yes, you still have to pay that 40,000. Well, I should say you should pay that 40,000 back, but that your money is still compounding from the 100,000, even though you took the 40,000 out. And so your place was held in line at the 100,000. And that's really the biggest part of it, is that your place is held in line, and anybody can do it on any level. I use a number like $100,000, but it could be $3,000, and you're doing this for Christmas. You know what I mean? For someone's birthday. It could be $5,000 because you're going on vacation. But the main thing is get involved and get your money working for you. I call it keeping your money in motion at all times. Okay. And so it's a simple concept. It's not something that you could just call your traditional financial advisor to do. It's simple, but the moving parts are complex. And so, but I'm sure that, there's some specialists in your area that could probably speak to it.
Yeah. I'm not sure how the laws would vary on all sorts of setups. It's a very complex thing over here as well, but I have a feeling that the same things would be possible. It would just be called something different. Mm-hmm. So what we were talking about just now with the life insurance and everything, and maybe withdrawing money, I know, having read Rich Dad Poor Dad myself, and the difference between assets and costs and things like that. Do you advise people to take money if they're looking to snowball that wealth? Do you advise people to take money and use it to get some sort of asset that will generate cash flow? Does that ever come up?
100%. And so if you're able to take that money from the policy and use that towards a specific asset. So I have clients who will use this for real estate. And I tell them it's like the policy and real estate, they're kind of like first cousins here. And so they will use the money. Let's just say if they're doing a house flip, they buy a house that, needs some work. They put work into it, and then they go ahead and they flip it. And let's just say they earn, $50,000 from that flip. They'll put it into a policy, and then they'll do the whole process over again. Their place is held in line, borrow from it, flip another house, refinance another house, so on and so forth. And they do this back and forth action, but we get further and further closer to the cashier, right? As we are moving up the line there. So, but yeah, using it with another asset, you're using it to start your own business. I know a lot of people who are 1099 who will put all of their commissions inside of here and allow, that tax burden to be a little bit less because their money's compounding, right? And so a lot of, my 1099 folks love to use this as well.
Can you define 1099 for us just to make sure everybody knows what it means?
Yes. So 1099 is that individual where the taxes aren't coming out. They're receiving that commission 100%. And then at the end of the year, they're going to be, they'll be able to write, their taxes off, based on their expenses that they've used. But they're receiving all of their money up front. No taxes are coming out of their paycheck when they're 1099.
That's a lot nicer.
Absolutely. Because you're more control whenever you're in 1099, because, a lot of the W-2, at least that's what we call it here, the W-2 employees. Well, anytime you get a tax return, that really means that you lent the government the money all year long, right? And so they're just giving you back what was already yours. Versus the 1099 way, we're just only giving them what belongs to them, while we already write off everything. So we're in more control when we do the 1099.
Yeah. It's all these phrases that I think we just need to make sure people understand what it means. to
100.
that because yeah, it's a complicated world of finance. So that's a really interesting strategy. I am wondering, once people take some of that money out of the life insurance and it still holds their place in mind, but they're just running an errand with it, like you said, running to get something else to the grocery store and come back to their place in line. Um, that money that they then, if they have purchased an asset and it starts accruing money or being profitable, is it advisable to take that money and put it back into the life insurance scheme? Or is it advisable? I know you said some people will roll it into another house, but at what point does that profit become need another home? Or does it ever? Because I know I hear a lot about setting up your businesses within a trust and things like this. And I'm wondering at what point you move into other financial forms or modalities.
Hey, that's a great point. So the policy is this like the central hub of everything. Because the beautiful thing is at the end of the day, it's still life insurance. So, that day whenever you do pass away, your heirs are able to have the keys to the kingdom per se. So it's a nice central place for it. In regards to keeping money outside of it and allowing it to accrue, let's just say within real estate, you're just able to take that money and purchase some more real estate and purchase more real estate. Um, that can be done, but they miss momentum by doing it that way because you got to think about it. So if we were to flip a house and roll money into a new house, well, that money needs to be deposited somewhere before we purchase that next house. So even if it's your savings account, checking account, money market account, it has to sit somewhere before the next transaction. Just by it sitting in the policy, it just moves you up in line. And we're taking it and we're moving it whenever we're ready to do it again with the next house and then the next house. And so although you can keep them separate, but you won't go as far up in line on the life insurance side by keeping it separate. But it also keeps you, anytime you borrow the insurance company's money as well, believe it or not, your money is still held in there and it's safe. And so God forbid you were to mess up on this other side outside of the policy. Well, no, your money's kind of 100% at risk, so the insurance company is backing your money with their money as you're doing it. And so that's the nice side about it, is that your money's also insured, even though, this is life insurance. And so not only is your life insured, but your money's insured as well. So it's a safer way to do it. Now, you mentioned about the trust. A trust is a very important piece of it. What's nice about a trust is the trust can own the policy. Okay. And so there's a book, I think it was called the Rockefeller's Way or something like that, where it explains how the Rockefellers use trust within their life insurance policies to amass the wealth that they have and the money that continues to grow from generation after generation after generation. And so trust is a very important part, but having the trust own the policy is like charging generational wealth for you and your family. You're on mute, Jeannie. I cannot hear you. I'm wondering what's happening. Okay. All right. So I read a book that was called Spend Differently. Okay. And in my book, that was the segue into Mortgage to Millions. And the whole idea of that was that there was going to be things that you were going to purchase regardless if we did business together. See, when I first got in the industry, I kind of got caught up doing a lot of budgeting for clients. And not to say that budgeting is bad or anything like that, but it was more or less telling them what they can do, what they can't do. And it's like, oh, this isn't fun. I work too hard for my money and I'm not able to, get Starbucks. Like, what are you telling me? And so, and I even realized, okay, this is kind of a hard way to do personal finance. And so instead of going that route, I just knew that there was a lot of money that clients were losing unknowingly and unnecessarily. And so what do I mean by that? Is that when you purchase a car, what happens is you lose the opportunity for that money to ever make you money again. Okay. And so this is what I mean is that when you purchase a car, you have two ways you could do it. You could use credit or you can use cash, right? And so most people use credit. They go to the dealership and they finance it. They go into debt and they pay it back, and they go into debt and they pay it back. And they're like right back at we call it the zero line. All right. But you also can use cash. You have enough money and you pay off the car, but then you're back at zero. And then you save back up and you're back at zero. And so with both of those options, you end up at the same place. What I show people is how to become a wealth creator, where we have the mindset of the saver, meaning you save up the money. But whenever you put it inside of the policy and you're using the insurance company's money, you don't come back down to zero. That's the difference. And so your money's held in place. And then as you pay it back and you purchase car number 2, you're at a higher place in line. You purchase car number 3, you're at a higher place in line. As you do this 3 or 4 times, the money that you're that's growing by compound interest will be enough to purchase the car itself, just by using that strategy. And I tell people this, Jeannie, because anybody, no matter what their income level is, could get involved in something like this. As long as they have a little bit of discretionary income, I would say probably a minimal of, maybe $150 or so that they're able to save per month. They could probably get involved with a strategy like this that we teach. And so I recognize, once again, people are going to go on vacation. They're going to be helping their kids through school. They're going to be purchasing houses. They're going to be purchasing cars, home improvements, maybe some weddings in the future. And so there's all these major capital purchases. And the one thing I tell a client, or I say a prospect when I first sit down with them, is the one thing I know about you without knowing much is you're going to spend a lot of money. And it's not because you're bad with money. It's just because you're human. All right. And you're going to spend hundreds of thousands of dollars, if not millions of dollars. And so in my book, Spend Differently, that's exactly what I'm showing you, is how to spend it differently, because I want to hold your place in line while you make all these big purchases anyway. I'm not the one who's going to convince you not to, give your kids a great Christmas, right? You're going to spend the $500 to $1,000 or what have you, regardless. My whole thing is, since you're going to do it already, let me just show you a better way. And so I don't want to convince you that it's a bad thing. That was kind of the old man. I realized that we had to kind of rewind it and come back a better way to educate our clients. Fast forward now to Mortgage to Millions. What I didn't recognize is that I was able to use this to pay off debt. And so when I wrote Spend Differently, I didn't have it in mind that I could use the same concept to pay off debt. And I was like, man, should I just write a new book? And so instead of doing it, I just created a whole program where I just teach people from beginning to end through video modules, and we break down all of the financial terms. We give real life case studies, and I really show people the ins and outs of how to put this together, whether they're using it to pay off debt, rather than using it to pay off a car. It doesn't matter what the situation is. How can this policy serve me? Because most people think like life insurance is only for their beneficiaries, right? Whereas the living benefits outweigh the death benefit. And so that's one of the things that we teach here.
Thank you for everything you've taught us so far. I've learned a lot. These are techniques I've heard of before, but when you hear these things online, you wonder, is that really legitimate? Because so many things online aren't. So it's good to know that, yes, it does actually work. So if we're looking at the overall structure of what you were talking about and setting up, and I know you help people with the actual execution of this, but for the overall structure, you said a trust owning the life insurance policy, and that turbocharges it was your phrase. Why does that, first off, when you talked a little bit about the trust, could you just explain to us what a trust technically is? And then when it owns a life insurance policy, why is that a turbocharge?
So with a trust, it's pretty much almost like a will on steroids. And what I mean by that, it's a place that you kind of hold your declaration per se of how you want your finances to flow after you leave. Okay. And so just a prime example, let's say in my case, I want to leave my business and everything to my children. But I need it to be spelled out a certain way. And so what a trust does is it brings attorneys involved, because only attorneys are able to help you form the trust. It's not something that you can I guess you can do it online. Maybe it's an attorney on the other side of it who helps you, but they help you with the language to make sure that whatever you want done will get done. And so that's what the trust is, to make sure that whatever you want to happen after you go will happen legally. I may not want my children to touch the money until they're a certain age. And so once they reach a certain age, they're able to have X amount of dollars. Once they're this age, then maybe they're able to have partnership in the business. Once they reach this milestone, they're able to do this. If they want to bring my grandchildren involved, then these steps need to be in place. All of those details can be explained within a trust. And so when I say it's kind of like on turbocharge, as the trust owns the policy, when you pass away, there's a big amount of wealth that's held in the trust that the attorneys control on your behalf to say that this is how we're going to divvy up in the Mitchell family per se, or the Rockefeller family. And, you could put stipulations to say, hey, you can't have access to this unless you have the same policy, because then now I know that my grandchildren will also be taken care of, and you're not hogging up everything that I'm passing to you. And so it could be very detailed to make sure that it duplicates all the way down. And with a lot of families, this is a big tradition for them to create trust and use the life insurance, because see, life insurance doesn't go through probate. So that money's passed down tax-free. And so, the courts aren't hassling your heir, their beneficiaries, about you owing on property or owing on, just any loans that you have. The life insurance goes directly to those family members without having to worry about any type of probate at all. So having that in a trust really secures to make sure that what you want done will get done.
Okay. I had two big questions pop into my mind with that.
Okay.
The first one was, well, actually, I'll start with the second one. The second one was when the life insurance goes to the family members, doesn't go through probate, does it pay out to them, or does it pass on as a life insurance policy for them?
It pays out to them.
Okay.
But if it's in a trust, it pays out to them the way you want it paid out to them. Okay. But just regular life insurance, whoever your beneficiary is will receive a check for that death benefit.
But with a trust, it would say, like you said, you could distribute a certain amount over a certain period of time, or they have to meet benchmarks or something.
Correct. And keep in mind that it doesn't even have to be to family. A lot of people do this for organizations. We may make my church the beneficiary. This may go to a particular business. This money is only be used to help my granddaughter start college. So it could be very specific as far as how you'll want that money distributed.
Oh, that is brilliant. I really like that because I think and I like that an attorney would get involved with it, because a lot of times we just don't know how to phrase these things so that they endure legally and can't be misinterpreted.
Mm-hmm.
Okay, I'm trying to remember the other question I had. It suddenly fallen from my mind.
I'm sure something else for you though.
Okay, go ahead.
Okay, so I want to give an example of, because you mentioned you see this stuff online, and you want to know is like, if is it really legit? How does it work? Because there are a lot of scam artists that are out there, and there's a lot of people, I should say, who are trying to do this and aren't educated. Okay, so I want to just kind of share an example, and hopefully this is clear to really help people understand. So if any of you are out there taking notes, this is a good time to take notes. And so let's say that you have a policy. It doesn't matter what the death benefit is, but let's just say you're able to pay $1,000 a month. That was your budget. Let's just start there. Well, what most insurance agents will do is they'll take that $1,000 a month and you'll purchase insurance. And they'll say that, hey, in a few years, you're going to have some cash value. It's going to look really nice 5 years, 10 years, 20 years down the road. And they're 100% right. But if you were using this to build your own bank, that would be a horrible way to do it. And that agent still will say, well, it's kind of like building your own bank, but, you shouldn't touch it for, at least 4 years. Because in a whole life policy, for those of you all who may or may not have one, there's a spot that's called cash value. And that's like the savings account portion of the policy. And in there, normally the first few years, the amount of money in it is zero. Normally, okay? Unless I'm building it for you, right? Or one of our advisors here. But okay, so we have the $1,000. What I know that maybe that agent doesn't know is that there's several ways to build the policy. If I take the $1,000 a month and all I do is get you insurance, the agent gets most of the commission. And that's why whole life kind of gets a bad reputation because of that. Whereas whenever we receive the $1,000, I'm going to make sure that most of that money is going to cash value. So how do we do that? Well, now let's go to the death benefit. Okay, let's say you need $1 million in coverage. Okay, so, and $1 million cost in whole life $1,000 per month. Okay, we're just making up numbers here, whole numbers. So, agent got a big commission. It's like, okay, $1,000 a month. Oh, I made it out pretty well. Well, what I know that the agent doesn't know, and even probably what the client doesn't know, is we can still get that $1 million, and it doesn't have to cost you $1,000 a month. So normally, people need that much insurance because they have a lot of risk. Kids are young. They still have a mortgage. They have a lot of debt, different things like that. So I know that that's only for a moment of time. So what I would propose is I would take that $1,000, and let's say we would say maybe 100 to 200 of it needs to be in whole life, and that would give us $100,000 of whole life, let's say. And then we would take maybe about $50 and get a $900,000 term rider that we would put on it. So the policy only cost about $200. I'm taking the $800 and guess what? I'm putting it right in your cash value day one. And so guess what happens? I get less commission, but you have a better policy. And as I do that for you, guess what you're going to do? You're going to tell all your family members that, hey, we all need to do this. Versus the other policy, it was expensive. You try to make sure like, man, do I have it every month to do it? Did I make the right decision? See, if this starts to become a burden, we've done it wrong. And so I'm making sure that this policy that you could afford for $1,000 only costs $200. Because if all hell does break loose and, you run against hard times, then you've already paid up the policy. And the policy, it could probably go on autopilot for a few months as you're in between jobs and life happens. You're taking care of a loved one. So it's a lot safer this way too. And so that's how we build them. And so there's three components. We have the whole life portion, we have a term rider, and then we have the cash value portion that we could put money directly inside of it. So every time you make your insurance payment, your policy is growing every single month. And so that's how we craft the policy.
That's really innovative. Don't know how you figure that out.
Well, you know what? It's one of those things where it's talking to underwriters about what we can and can't do. And just through research found it out that we could put money directly into the cash value versus putting it in a regular savings account. And that's what we would want to do. And by doing it that way, like I said, it's a lot safer to the client. The agent gets less commission, but it's not really about how much I make on a per client basis. I would rather my name be associated with families and helping families build wealth than looking for one-time commissions. And so by doing it this way, obviously, we receive so many different referrals because we're helping so many families out and we're educating them too. So in the Mortgage to Millions program, just what I shared with you, we have a whole module where it breaks it all down. And so we want you educated on everything that we know here so that now you're speaking the same language that we speak whenever we're putting these policies together. So we really want to make sure that you understand all the moving parts before moving forward, because this is a long-term commitment here. You know what I mean? We're in on this together,
I want to make sure people understand what you meant there when you said rider. Everything you just said, I totally agree with, and I think it's really creative. I just want to make sure the terms are, for those who are listening and haven't bought your program, when you say rider, and they're saying, well, I do need $1 million life insurance policy, what does that mean that there's a $900,000 rider?
Great question. So a rider, imagine you had a hamburger. A rider's like toppings, okay, that you can put on top of a hamburger or whatever you're eating. So the main course would be the hamburger itself, okay? And the rider is what we're putting on top. So we have whole life insurance and we have term life insurance, and so whole life, just like the name itself, it covers your entire life. And term, just like the name itself, it covers you for a specific time period, 10 years, 20 years, 30 years. So just making sure that we're clear on just whole life versus term. Whole life is traditionally a lot more expensive than term insurance. But with term insurance, we know that you really only, not gonna say only need it during certain moments of time, but that's how we use it, because there's more times where you need more insurance. And, and that's whenever there's a lot of debt, you have a lot of dependents, your income is needed in your household. And so you have two options to make sure that your beneficiaries are covered. You could do it by way of whole life insurance, or you could do it by way of term. Now, within a whole life policy, we can add a term rider. So not necessarily a whole term policy itself. We're just putting an add-on of a term rider, just adding a topping to it. It acts as if it's its own term insurance policy, but it's just a rider on top of the whole life. All right. And they both work hand in hand. It's a little cheaper to have the term rider than a term policy, by the way, too.
I didn't know that. Well, I love the way you've explained it. And it makes a lot of sense that you, as your wealth grows, you're going to need a less expensive insurance policy because you already have the other, less expensive. You wouldn't need the term as much. Mm-hmm. So it's adaptable to your situation. It's something I think a lot of people don't know about. With that, I think the other thing that I wanted to clarify with that is you were talking about at the beginning, life insurance policy and using that as your bank. And now we've gotten to different types of life insurance, the whole and the term, and there's different breakdowns of the cash value and things like that. So if you're deciding to follow your program and to take money out and use that, let's say you're starting a business and you want to take out $30,000 loan out of your insurance. What area is that money coming out of in conjunction with what we just discussed? Because now that we've added in these other terms, it's a little more unsure.
No, great question. So the cash value is the money that is like your savings account that's in the policy. Whenever we're going to take that loan out for the business, like you mentioned, $30,000, that's coming from the insurance company's reserves.
Right.
Okay. But they're qualifying you for the $30,000 because you already saved that up into your policy on the cash value. So they're taking a look at your cash value and saying, oh, well, yeah, you have $50,000. Of course, Jeannie, you could borrow $30,000 of our money. You already gave us $50,000 of yours, no problem.
Okay, that clears it up. Thank you for that. I was wondering at what point that starts to become but you were saying, you could do this with any amount, even starting on a smaller amount.
Correct. Any amount. And so now someone may ask, here's a good question that your audience may want to know. Well, what happens to that loan if you were to pass away? Mm-hmm. Okay. And so let's say we're going to go back to you having that $1 million in coverage. And you took out, now don't forget $1 million in death benefit, but let's just say your cash value may be at $50,000 and you borrow $30,000. Okay. Then what would happen is the insurance company would look at the $1 million death benefit. They would also look at that you've grown your policy to $50,000. So if you never took out the $30,000, your heirs would probably get $1,050,000, $1,060,000. Okay. So they're going to take that minus the loan. Okay. So your heirs would probably get right around $1,020,000 if you borrowed $30,000 out. Okay. So whatever your death benefit is minus the loan is what would be given to your heirs, beneficiaries.
That makes sense. They're just recouping whatever it was that they loaned. Yeah. Wow. What an interesting strategy. And it's really nice to know that it's actually real, that people can do it. Where can people find you when they hear this and they say, I have debt, I want to make money, and I want to have my money earn me money, which is something a lot of people need to understand that is possible.
Absolutely.
So where can they find you when they want to look for you?
You know what? One of the best places to find me is on LinkedIn. You can just look me up. I'm the only Tayon Mitchell there. So you can find me there. And if you also want information for Mortgage to Millions, one thing Jeannie, I said our program is valued at a little over $1,000. Okay. But one thing I could do for your audience, although we're in different, countries, I still would be willing to gift the information to them though. Okay. And so, they could feel free to sign up at mortgagetomillions.net and, kind of put your information in there. And I wouldn't be opposed to having a conversation to even learn what I don't know on your side, and even maybe find what other carriers in your area may operate the same way that some of our carriers do here, and maybe be able to point them in the right direction. But they'll at least be able to understand the concepts there. And so you can find me on LinkedIn, Tayon Mitchell, or you can even go to mortgagetomillions.net, and we'll be able to gift you the program, and you can learn all the terminology and take the quizzes and learn the ins and outs of what we teach here.
Oh, that is brilliant. That'll be so helpful for so many people. One last question before we finish up here. And we've talked a lot about this, and it's great for people who are in a situation where they're making that money and they're wanting to, well, not making a lot of money, but making enough that they want to start that change and enroll. But I would like to also extend an invitation and maybe a bit of a motivation to people who are younger, who are wanting to start a wealth snowball. Why on earth should they bother even worrying or thinking about how to create wealth when they're, say, 16, 17 years old?
Absolutely. A great question. Well, the thing is when you're talking about compound interest, your money is growing every single year. So the earlier you start this wealth snowball, and I would even just say just cash value accumulation, because, you may not have any debt at that age. The faster we can get your money compounding in the early ages. I mean, anyone who does this concept, everyone says, I should have started earlier. I should have started earlier. So if you're listening to this podcast, start now, because you don't want to be that person who says, I wish I would have started earlier, because age does matter. Because we got to remember, in this program here that we're talking about, it's life insurance. And so because you're younger, the cost of insurance is also low as well. So that's very beneficial. The fact that your money can compound earlier, and now you could have your money compound for decades at a time, that's going to be so much more beneficial. So the sooner that you could start, the better, because you don't even need a lot of money. And by the time you're looking to retire, if you want to retire, you'll be so far ahead, and you'll be able to pass down that to your family, and be able to teach so many people what you have done. And so I highly recommend that the sooner, the better, for sure.
Brilliant. I think I really like the way you approach it as well. Instead of some austere, you can't have approach, it says, well, you need to live life. Let's teach you how to do it in a way that benefits you, benefits the people that you care about, and lets you enjoy your life.
Correct. Absolutely. And I do have a strategy for any business owners that you may have who watch this podcast. I'm not sure how the tax laws are there, but let me share with you one of the tax laws we have here. Is that business owners, they get a write-off where they can write off up to, I want to say it's $13,000 or $14,000 per child for a minor. Okay, and the reason why I mention that is life insurance within itself, at least here, isn't tax deductible. However, one of the legal loopholes is if I have my child work for me and my child works a certain amount of hours, I'm legally able to write off $14,000 up to $14,000. I could take that $14,000 and now put it right into a policy. And now I'm saving up for their college fund every year and things like that. And I could do that for every child. So it's a way to legally write off life insurance through your child helping you out in your business. And let me just tell you, there are dozens of strategies like that that exist. That's just a simple one that some of your business owners can follow right away. Even if it's not 14,000, it may be 5,000, whatever you could do, but you're able to take that money and put it right into the policy. You also can get your write-off at the same time.
There are policies similar to that in the UK. I know there's one that is pushed by banks a lot, where they are saying if you save up for your children X amount, and you can do this per year and it's tax-free, but those are banks that are offering that service, and it's probably not the best return for your money.
Right. Mm-hmm.
All right. Well, thank you so much. We'll put all the links below for everyone. Tayon, I appreciate your time and your skill and your willingness to prioritize the families you're helping over your own wealth accumulation, which I hope goes really well as well for you. Thank you, Tayon.
No problem. Thank you so much. It's been fun.
Cheers.
Bye-bye.